GIC Re presents CNBC-TV18 Mutual Fund Awards 2018.
I'll keep this short and sweet. Obviously, you all know everything about equities, nothing incrementally to, draw out here. But obviously, we have been very worried about the near term, right? Everybody is very worried that this is the start of a bear market and all that. So I thought, if not anything else, but to soothe the nerves, collective nerves, let me try to bring out what equity really holds for in the long term, right? So equity essentially is an option instrument. The good part is we are buying a call option and it is undated, right? Typically what happens with call options often is that because of the fixed time duration, even if you're right, you might not make money. But here is an instrument which has no date, and that I think is the most brilliant point about equities. Obviously, the probability of getting right is low, but let's focus on the positives first. Now, what happens if you get the thing right? Let's say 25% compounding over 30 years, 800 times return. Now, if that doesn't make you greedy about equities, I don't know what else will, right? So, clear message is equity is a long-term asset class. It's an undated call option that you're buying. And really, you can make any amount of money if you get your stocks right. Unlimited upside, limited downside. The downside is only the price that you pay initially. So asymmetric risk rewards, right? Now let's look at our own 30-year history of Sensex and what has happened when you have invested in Sensex over the last 30 years. Before that, we know that with higher risk, you expect higher return. But also the dispersion of the returns increases as you take more risk. So that's an important point to note before we get into how Sensex returns have really played out. This is 3 sets of data for the entire Sensex duration: 6-month rolling returns, 3-year rolling returns, and 10-year rolling returns, right? So if you have been invested for 6 months versus 3 years versus 10 years, clearly the return experience improves as your tenure improves. But more importantly, the standard deviation, the volatility of your returns comes down drastically. So risk-adjusted returns really improve substantially as you invest for the long term, right? This is a statistical presentation of the data that we have computed. Thankfully, while doing this data, I was wondering whether it will fit a normal curve or not. It did, and I was very happy about that, right? For some reason, I don't know why, but I tend to like the normal curve a lot. Good part is, well, let's start with the bad part first. Near term is all about volatility, and near term also has fat tails, both on the negative and the positive side. Thankfully, there's a huge fat tail on the positive side, which is what many people get attracted to about equities, right? Most people who come into equity markets, 90 out of 100, are coming in for short-term positive volatility experience. That fat tail that you're seeing on the right-hand side, that is what people are looking for. Majority of the participants in the market are looking for, I believe. That fat tail remains to some extent, even up to 3 years. But the beauty is, if you take 10-year duration, if you remain invested in Sensex over a 10-year duration, the fat tails disappear. And you get a very good dispersion of outcomes. The mean also improves, obviously. So essentially, there's a funnel. The return dispersion really constricts beautifully over the long term, so making it a much more predictable asset class, right, compared to the short term. And the means also improve. So fundamentally, the risk-adjusted return is what is improving here. So this has been worded beautifully by Benjamin Graham that in the short run, the market is a voting machine, and in the long term, it's a weighing machine. So if and only if you remain invested in equity for the long term, do you really realize the true potential of your investment that holds for a portfolio of stocks, that holds for the index, that also holds for individual stocks, right? Now, let's look at the risk from a more conventional perspective. The real risk that any investor who invests money is what is the chances of a permanent loss of his or her capital. The shaded area under the curve is what the chances of permanent loss of capital are. Here again, we see that with increasing duration, the top is 3 months, 6 months, the middle is 3 years and the bottom is 10 years. With increasing duration, clearly the chances of a permanent loss of capital decreases and becomes zero as you increase your duration to 10 years. Similarly, that was for the Sensex data. Similarly, for Nifty, other people have computed that the axis here changes, and the dispersions that you see are essentially the heights of the bars, both on the positive and negative side. So as you see, going from a 1-year holding duration on the Nifty to a 15-year duration, the return experiences improve drastically. The dispersions come down beautifully. Averages also improve a bit, right? And the most important part is beyond 7 years, you don't experience negative returns. So presenting it in another way, the probability of loss sees an exponential decay as the holding period really increases, right? So if you hold equity for the long term, probability of losses are very low, they keep coming down, and your returns are pretty good. Risk-adjusted returns are essentially very good. So that means that equity really is a long-term asset class. Of course, you have to remember that like any other call option, there is a real risk of a permanent loss of capital, a complete erosion of capital too. But if you get your stocks right, you can make any amount of returns. So that brings me to the second question, the obvious question: how do we find such stocks, right? How do you increase your chances of getting stocks which are really long-term multi-baggers? Firstly, long-term multi-baggers, and this is from our wealth creation study, are really low, right? The chances of getting a very healthy price CAGR, 25% plus, are in the early or mid-teens over a 20-year price history. So that clearly tells you that you have to work that much harder, or you have to have a method to find companies which can give you a very high compounding over a long period of time. Two things matter here: longevity of the competitive advantage of the franchise, as well as the longevity of growth. So these two things, moat and growth, determine the long-term compounding potential of any stock. So essentially, if you plot that on a BCG matrix, 2x2 matrix, essentially the top right quadrant, high growth and very good moat, is what will get you that. Now we are living in times of somewhat higher uncertainty now. Volatility has come back to global markets, Indian markets too. So let me end that with a note on volatility, how the volatility experience plays out even in great stocks. Even if you have found a great multi-bagger, Amazon, 350x in whatever number of years, but there have been 3 instances where the stock has actually fallen 50 to 90% plus in short durations of time. So that essentially also tells you that to be a successful equity investor, you need patience, you need guts, you need conviction to ride out the short-term corrections. That, ladies and gentlemen, is my simple message. Thank you for this opportunity again. Thank you, CNBC.
GIC Re presents CNBC-TV18 Mutual Fund Awards 2018.